In previous session, we learnt about the meaning of double entry system, accounting equation and how to pass journal entries. These points are to be recalled before learning ledger. Today, we are going to present a lecture on meaning of ledger accounts, what are the procedure for posting from journal to ledger, the meaning and features of trial balance, and the objectives of preparing trial balance and methods of preparing trial balance. Now we are going to see about what is the meaning of ledger. Ledger is known as principal book of accounts. It is a book which contains all set of accounts, namely personal account, real account and nominal account. Here account wise balance can be determined from the ledger. Here the ledger accounts are prepared based on the journal entries passed. Now we are going to see about what are the rules for posting of accounts. Here posting means recording the transaction in ledger from journal or other subsidiary books. So what are the rules to be followed or what are the rules to be observed while posting entries from journal to ledger? First we have to open the account. First one is opening of an account. Opening of an account in the sense, for example, wages account, furniture account, machinery account, capital account, purchase account, sales account, etc. Then second step is write the date in the account on the proper side. Then next one, all transactions related to one account should be written on one page. Then next one is debit, that is they are shortly called DR, is written on the top corner of the debit side, and credit CR is written on the top corner of the credit side. So all the debit entries are written with to and all the credit entries are written with by. Then next one is the amount written in the debit side of one account should be the same as written in the credit side of other account. Then folio column is meant for writing the page number of journal or subsidiary book. Folio column is nothing but it's writing the page number of journal or subsidiary book from where posting is being done. Therefore, it should be filled by the page number of source book.
Now, we shall see the features of ledger. There are so many features of ledger. First one is it is a principal book of accounts. So the main features of ledger is the principal books of account. It is prepared with the help of data provided by the journal. Ledger is prepared only with the help of the data available in the journal. Okay. The balances of all nominal accounts are transferred to the trading and profit and loss account at the end of the period. So the balances of all nominal accounts are transferred to the trading and profit and loss account at the end of the period. The balances of real and personal accounts are shown in the balance sheet. The balances of real and personal accounts are shown in the balance sheet. Trial balance is prepared with the help of the closing balances of all accounts maintained in it. The trial balance is prepared with the help of the closing balances of all accounts are maintained. It depicts the present position of the accounts. So ledger which helps to know about the present position of the accounts. So what are the basic features of ledger? First one is it is the principal book of account. Second one is ledger is prepared only with the help of the journal. Next point is The nominal account balances are transferred to the trading and profit and loss account at the end of the period. For example, salary account, commission paid, discount allowed. So all these nominal accounts are transferred to trading account and profit and loss account. The balances of real and personal account are shown in the balance sheet. Building purchased, furniture purchased, that will be shown on the asset side of the balance sheet. All real accounts that should be shown on the asset side of the asset side of the balance sheet. Then received loan from bank, that is recorded in liability side of the balance sheet. So the balances of real and personal accounts are shown in the balance sheet. Then next features is trial balance is prepared with the help of the closing balances of all accounts maintained in it. So after completion of the ledger, then only we have to prepare the trial balance. So with the help of closing balances, trial balance is prepared. So it depicts the present position of the accounts. So ledger, which helps to know about the present position of the accounts. So these are the basic features of the ledger. Then next one is merits of ledger. There are so many advantages of ledger. First one is knowledge of business results. Knowledge of business results. From the ledger, all transactions related to one item are written at one place, and all the important information related to business can be obtained easily from this. So that is the advantages of knowledge of business results. Okay, here that is simply called all transactions related to one item are written at one place. For example, cash account. So all cash transactions are recorded under the cash account. That means all cash receipts are recorded on debit side, all cash payments are recorded on credit side. The difference between these two is cash in hand or cash at bank. It is closing balance in hand. Okay. So from the ledger, all transactions related to one item are written at one place, and all the important information related to business can be obtained easily from this transaction. That is a knowledge of business results. The next one is helpful in preparation of trial balance. The trial balance is prepared from the ledger balances. So, and arithmetical accuracy can be checked with the help of trial balance. So, ledger helpful in preparation of trial balance. The trial balance is prepared from the ledger, and arithmetical accuracy can be checked with the help of trial balance. Then the next advantages is helpful in preparation of final accounts. Helpful in preparation of final accounts. Ledger provides all information for the preparation of final accounts. So ledger provides all information for the preparation of final accounts. Hence, these can be easily prepared to ascertain the gross profit, net profit, as well as the financial position of the business at the end of the year. So, ledger provides all information for the preparation of final accounts. So, it can be easily identified, it easily prepared to ascertain the gross profit, net profit, as well as financial position of the business at the end of the year. Then last advantages is to overcome the limitations of journal. To overcome the limitations of journal in the sense, from this the complete information related to any transaction cannot be obtained. However, from the ledger, the complete information about any item can be obtained easily. Is it clear? So, the limitation of journal is that from this complete information related to any transaction cannot be obtained, but from the ledger, the complete information about any item can be obtained easily. Okay. Now, we shall see format of ledger. In this format of ledger, there are two sides of an account. Left hand side is debit side and right hand side is credit side. In both the sides, the first column is for date and second column for details, third column for the journal folio number, and in the last column the amount of the transaction is recorded. Here there are two sides of an account. Left hand side is debit side and right hand side is credit side. In both the sides, the first column is for date and second column for details of the details or particulars, third column for the journal folio, and in the fourth column the amount of the transaction is recorded. So this is a format of ledger. Now looking in the rules for writing up accounts of various types. That is, posting means transfer of entries from journal to ledger is called posting. What is the rules for writing up accounts of various types? In case of assets, if asset increases on the left hand side or the debit side and decreases on the credit side or the right hand side, here assets should be recorded if the asset increases on the left hand side or the debit side and decreases on the credit side or the right hand side. Then liabilities. Liabilities like increases on the credit side and decreases on the debit side. Liabilities should be recorded increases on the credit side and decreases on the debit side. Then capital, the same as liabilities, that is increases on the credit side and decreases on the debit side. Then expenses, increases on the debit side and decreases on the credit side. Next, income and gains, increases on the credit side and decreases on the debit side. Here first one, asset. Here asset. So asset increases on the left hand side or debit side, increases on the left hand side or debit side and decreases on the credit side or the right hand side. Okay. Then next to expenses and losses, the same thing is applicable. Expenses and losses increases on the debit side, decreases on the credit side. Then liabilities and capital, increases on the credit side and decreases on the debit side. The last one is income and gain, increases on the credit side, decreases on the debit side. So this is a basic rules for writing up accounts of various types. Then typical ledger account balances. Generally, here all assets accounts. All assets account shows only debit balances. All assets account shows only debit balances. All liabilities accounts which shows only credit balances. Capital and owner's equity account which is also shows credit balances. Expenses or loss accounts which shows debit balances. Incomes and or gain account that shows credit balances. That is asset account, expenses and or loss account, which shows only debit balances, liability, capital and owner equity account, incomes and gain account. These account shows credit balances. So this is a typical ledger account balances. Okay. Then types of ledger accounts. There are two types of ledger account. One is personal ledger account and another one is impersonal ledger account. There are two types of ledger accounts. One is personal ledger account and another one is impersonal ledger account. Again, personal ledger account is divided into debtors ledger and another one is creditors ledger. And impersonal ledger are classified under cash book and general ledger account. That is, the ledger accounts are classified into two. One is personal ledger and another one is impersonal ledger. Personal ledger again classified into debtors ledger and another one is creditors ledger. The impersonal ledger are classified as cash book and general ledger. Okay. Then what is personal ledger? Personal ledger in the sense the ledger which contains the accounts of persons or organization is called personal ledger. The ledger which contains the accounts of persons or organization is called personal ledger. These accounts are relating to persons or organization whom goods are bought or to whom goods are sold on credit. These accounts are relating to persons or organizations whom goods are bought or to whom goods are sold on credit. The personal ledger is again divided into debtors ledger and another one is creditors ledger. What is debtors ledger? It contains the accounts of debtors to whom goods are sold on credit. That is, it contains the accounts of debtors to whom goods are sold on credit. It is also called sales or sold ledger. This is otherwise called sales or sold ledger. The name debtors ledger is more appropriate than sales or sold ledger as it contains debtors account and not the sales account. Okay. The name debtors ledger is more appropriate than sales or sold ledger as it contains debtors account and not the sales account. So it contains only the account of debtors to whom goods are sold on credit. So this is otherwise called sales or sold ledger. The name debtors ledger is more appropriate than sales or sold ledger as it contains debtors account and not the sales accounts. Then next one is creditors ledger. It contains the accounts of creditors from whom goods are bought on credit. It contains accounts of creditors from whom goods are bought on credit. It is also called purchase or bought ledger. The name creditors ledger is more appropriate as it contains a creditors account and net purchase account. Okay, the name creditors ledger is more appropriate as it contains the creditors account and net the purchase account. This is otherwise called purchase or bought ledger. It contains the accounts of creditors from whom goods are bought on credit. So that informations are recorded in creditors ledger. Okay. Then next one is impersonal account. Impersonal ledger. Impersonal ledger means the ledger where details of all transactions about assets, income and expenses are recorded is called impersonal ledger. The ledger where details of all transactions about assets, income and expenses are recorded is called impersonal ledger. Again, impersonal ledger is divided into cash book and general ledger. Impersonal ledger again divided into cash book and general ledger. Cash book means the book where all cash and bank transactions are recorded is called cash book. The book where all cash and bank transactions are recorded is called cash book. Then general ledger. General ledger is the ledger where all transactions relating to real accounts, nominal accounts, details of debtors ledger and creditors ledger are recorded is called general ledger. General ledger in the sense the ledger where all transactions are relating to real account, nominal account, details of debtors ledger and creditors ledger are recorded is called general ledger. General ledger may again divided into two groups. One is nominal ledger and another one is private ledger. General ledger may again be divided into two groups. One is nominal ledger and another one is private ledger. Nominal ledger means the ledger where all transactions relating to incomes and expenses are recorded is called nominal ledger. The ledger where all transactions relating to incomes and expenses are recorded is called nominal ledger. Then private ledger. The ledger where all transactions relating to assets and liabilities are recorded is called private ledger. The ledger where all transactions relating to assets and liabilities are recorded is called private ledger. Is it clear? Okay. Let us see the difference between journal and ledger. Here the transactions are recorded in a chronological order. The transactions are recorded in a chronological order, that is date-wise order. This process is called journalizing. Ledger is a book of which entries are recorded in different accounts by transferring from journal. So this process is called posting. This process is called posting. The next one is the journal is a book of original entry. Ledger is a book of final entry. Journal is not prepared on the basis of ledger, but ledger is prepared only on the basis of journal. Narration is written with every entry. Narration is written with every entry, but narration is not written. Balancing is not done in the journal. Balancing is not done in the journal, but here balancing is all the accounts are balanced. Final accounts are not prepared. Final accounts are not prepared with the help of journal. Here final accounts are prepared here. Final accounts are not prepared here. And this ledger account, final accounts are prepared with the help of ledger. Here recording are made date-wise transaction. Here recording is done account-wise transaction. Okay, so what is the difference between journal and ledger? Okay, journal, all the transactions are recorded on the basis of chronological order or date-wise order. So this process is called journalizing. So day-to-day transactions are recorded. Then next one is but ledger, here the entries are recorded in different accounts which was transferred from journal. So this process is called posting. That is transferring entries from journal to ledger is called posting. Okay, the transfer of entries from journal to ledger is called posting. Next difference is journal is a book of original entry or prime entry, but ledger is a final entry. After recording the transaction in the journal, then the transaction are posted to the ledger account. So journal is a prime entry or first entry or original entry, but in the case of ledger, which was final entry. Then next difference is journal is not prepared on the basis of ledger, but ledger is prepared only on the basis of journal. Okay, journal is not prepared on the basis of ledger in the sense a journal is a prime entry. So this was the transactions are firstly recorded in the books of journal. So this is not prepared on the basis of ledger, but ledger is prepared only after the completion of the journal. So it's fully based on journal. Then narration. Here under this journal, narration is written with every entry in the journal. Narration is written with every entry in the journal. But in the case of ledger, narration is not written in the ledger. Then on the next one is journal. Balancing is not done in the journal, but in the ledger all the accounts are balanced. In the ledger all the accounts are balanced, but journal balancing is not done in the journal. Here next one is final accounts. Here on the base of journal, final accounts are not prepared. So final accounts are not prepared with the help of journal. But in the case of ledger, final accounts are prepared with the help of the ledger. Then next one is journal. Recording is made date wise order, but here recording is done account wise order. In the case of journal, recording is made date wise order, but in the case of ledger, recording is done account wise order.
Now we are going to see about the ledger accounts. From the following particulars, prepare the account of Raja, the proprietor of the business. Balance the same and explain what is the closing balances indicate. Here capital introduced rupees 30,000. Drawings made by him rupees 6,500. Further capital introduced rupees 22,000. Profits for the year period 7,500. Here we have to prepare the capital account. So capital introduced, that is the opening balance. That is the amount of capital introduced by the Raja, he is a proprietor. Then drawings made by him. So the amount withdrawn by the proprietor for his personal use rupees 6,500. Then further capital introduced. Additionally, they have to introduce the amount of capital is 28,000. Let us see the problems in ledger account. From the following particulars, prepare the account of Raja, the proprietor of the business. Balance is same and explain what does the closing balances indicate. First one is capital introduced rupees 30,000. Drawings made by him rupees 6,500. Further capital introduced rupees 22,000. Profits for the period 7,500. Here the Raja introduced the amount of capital for starting the business rupees 30,000. Okay, so here journal entry is cash account data to Raja's capital account. Then drawings made by him. Here drawings in the sense proprietor Raja, they withdraw the amount for his personal use. Then further capital introduced. Additionally, the amount of capital introduced by the Raja. Then profit for the period rupees 7,500. Now we are going to see how these problems are recorded in the Raja's capital account. Here first one is the amount of capital introduced by Raja. So cash account data to Raja's capital account rupees 30,000. So by cash account rupees by cash account rupees 30,000. So how these transactions are recorded in the Raja's capital account? Here first Raja started the business with capital. So cash account data to capital account. So by cash account rupees 30,000. Then next one is they withdraw the amount of capital from their business for his personal use. So that should be recorded as drawings. So Raja capital account data to drawings account, because the amount of capital will be reduced. So drawings account will be credited. Raja capital account data to drawings account rupees 6,500. Then next one is additionally the amount of capital introduced by the Raja by cash rupees 22,000. Then profit for the period is 27,500. So profit and loss account data to Raja's capital account 7,500. So by profit and loss account 7,500. So the total of all this credit side total is 30,000 plus 22,000, 52,000. 52,000 plus 7,500, 59,500. So 59,500 is the credit side total. Here debit side total only 6,500. So how to equalize the total 59,500 minus 6,500, The difference between these two is 53,000. So 53,000 is the balancing figure. So this amount was recorded as to balance carry down. So to balance carry down rupees 53,000. So that amount was carried forward to the next month. By balance brought down rupees 53,000. That is by balance brought down 53,000. Is it clear? So the amount of capital, first one is the amount of capital introduced by Raja rupees 30,000. Cash account data to Raja's capital account. So by cash account 30,000 is a credit column here. So this is a credit side. Here debit side. So cash introduced by Raja, additional capital introduced by Raja rupees 22,000. So it's the same entry, cash account data to Raja's capital account. So by cash account 22,000. Then profit during the period is 7,500. So the amount of capital will be increased. So by profit and loss account data to Raja's capital account 7,500. Then drawings, the amount of drawings in the sense the Raja, they can withdraw the amount from the business for his personal use 6,500. So to drawing 6,500, it reduces the amount of capital. So the difference between these three is 53,000. That is the closing balance of the amount of capital in hand. Then this amount was transferred to the next month by balance brought down rupees 53,000.
Now looking in the problems in ledger accounts. How the transactions are recorded in the journal. After recording the transactions in journal, how these transactions are posted to the ledger accounts. Now you see the problem. Enter the following transactions in the journal of Ramesh and post them into ledger. Enter the following transaction in the journal of Ramesh and post them in the ledger. 1st January 2006. Assets in hand. Cash rupees 630. Cash at bank 23,100. Stock of goods 26,400. M&M Company 6,750. Liabilities Marathi and Company rupees 3,880. Raman Sons rupees 3,000. January 2nd. Received a check from M&M Company in full settlement rupees 6,650. January 4. Sold goods to Chan & Sons on credit rupees 1,440. On the same date, carriage paid rupees 35. Sold goods to GN Company for cash rupees 3,120. January 5. Bought goods from Raman Sons on credit rupees 4,000. Paid Marathi and Company by check in full settlement rupees 3,800. January 6. Bought goods from Chatterjee rupees 6,300. January 13. Returned goods to Chatterjee not being up to specifications rupees 300. 16. Goods used personally by proprietor rupees 50. Date 17. Sold goods to M&M Company rupees 5,000. 20th. Check receipt from Chan & Sons rupees 1,440. 22. Bank advisors Chan & Sons check return unpaid. 24th. Cash deposited with bank rupees 2,000. 27th. Check sent to Chatterjee discount allowed rupees 150. Rupees 5,850. 31st. Paid salary 600. Paid rent rupees 300. Drew for personal use out of bank rupees 500. So these are the different transactions in the month of January 1st to 31st January 2006. So first one is asset in hand, that is opening balances. So opening balances, cash in hand, cash at bank, stock, then MN company datas. So these are the assets. So assets always shows debit balances because it increases the asset. Okay. So what is the journal entry? Cash account debited, cash at bank account debited, stock account debited, MN company account debited. Here what are the liabilities are? Marathi and company, that is he is a creditor. Then Raman Sons, he is also a creditor. So creditors account will be credited. So to Marathi company, to Raman and Sons account. Then next transaction is received a check from MN company in full settlement. Here already the debtors pay the amount of 6,750. So the amount settled only the amount of 6,650. So what is the difference between these two? 100 rupees. Okay, 6,750 minus 6,650. So 100 is a discount. So discount rupees 100, discount allowed. So we are allowing the discount. So that is the expenses for us. So discount account will be debited. Okay. So we received the check from MN company in full settlement. So we allowed the discount 100 rupees. So what are the accounts involved here? Discount account, MN company account, and another one is check. That is cash on bank account. Then next one is sold goods to Chandan company on credit. So this is a credit transaction. What are the accounts involved here? Chandan Sons, and another one is sales. Chandan Sons and sales. Okay, so Chandan Sons is a personal account. So that account will be debited. Debit the receiver. He is receiving the goods. Then sales, goods sold out of the business, goes out of the business. So that account will be credited. So Channel Sons account debited, sales account will be credited. Then carriage paid, that is the expenses, nominal account. So this is relating to nominal account. So debit all expenses and losses. So this is one of the expenses. So this account will be debited. Carriage account data to cash account. Then sold goods to GN company for cash. So this is a cash transaction. Cash transaction. So cash account and another one is sales account. Cash account and another one is sales account. Cash and sales both are relating to real account. So cash account will be debited and sales account will be credited. Then next one is bought goods from Raman Sons on credit. So bought goods from Raman Sons credit transaction. So here what are the accounts involved here? One is purchase account and another one is Raman Sons account. Purchase account and another one is Raman Sons account. Then paid Marathi and company by check in full settlement. Paid Marathi company paid full settlement. Here already creditors amount is 3,880. Here the amount settled only for 3,800. So remaining 80 is the discount received. So 80 is the discount received. That is considered as discount. That is paid Marathi by check in full settlement. Already the amount payable to Marathi 3,880. Now the amount paid to Marathi 3,800. So 3,880 minus 3,800, 80 rupees is a discount received. Okay. So discount received. So discount received is a nominal account, that is income. So that should be credited. So what are the accounts involved here? One is Marathi account. Marathi account. Next one is bank account. And another one is discount account. Marathi account, bank account and discount account. There are three accounts involved here. Then bought goods from Chatterjee. That is purchase account and another one is Chatterjee account. Purchase account and another one is Chatterjee account. Then return goods to Chatterjee. So purchase return. That is not we have specification. So the goods are returned to Chatterjee, purchase return. So Chatterjee account data to purchase return account credited. Goods used personally by proprietor. So personally by proprietor. Personally in the sense we have to use the drawings account. Drawings account here goods. Goods in the sense purchase account. So goods used. So we have to use the term purchases. Goods used personally by proprietor. So goods in the sense the stock will be reduced. Okay. So purchase account. Personally in the sense drawings account data to purchase account. Then sold goods to M1 company. Sales and another is M1 company. Sales and another is M1 company. Check receipt from Channel Sons. Check receipt. So bank account data to Channel Sons. Then bank advisors Channel Sons check return unpaid. There is check dishonor. So Channel Sons and another one is bank account. Then cash deposited into bank. What are the accounts involved in cash account and another one is bank account. Then check sent to Chatterjee. So check account, Chatterjee account and discount allowed account. Paid salaries, rent, that is expenses for us, so that account will be debited. Then draw for personal use out of bank. So personal use, that is a drawings. So drawings account data to bank account. Okay, is it clear? So this is a first we have to identify the transaction. Which account is to be debited and which account is to be credited. After identification of the accounts, next we have journal account. Okay, in the books of journal. January 1st, 2006. Here, what are the assets we have? Cash account data 630, bank account data 23,100, stock of goods account data 26,400, M&M company account data 6,750. Then credit side is liabilities Marathi and company 3,880. Raman Sons 3,000. Then Ramesh Capital, the difference between these two, 50,000 is a transfer to Ramesh Capital account. Okay, here there are different assets, they brought forward, here different liabilities. So the difference between these two is 50,000 is the amount of capital, that is a balancing figure. The next one is, next account is check received from M&M company and discount allowed. So what is the journal entry? Bank account data, discount allowed account data, discount allowed account data, discount allowed account data to M&M company account. So here bank account data rupees 6,650. Discount allowed rupees 100 to M&M company 6,750. Okay, so the narration for this transaction is being a check received from M&M company and discount allowed. Then next one is goods sold on credit. So Channel Sons account data to sales account. Account data to sales account rupees 1,440. Next transaction is carriage paid. What is the journal entry? Carriage or goods account data to cash account. The amount for carriage paid rupees 35. The next one is goods sold for cash. Next transaction, goods sold for cash, cash account data and sales account. Amount is 3,120. 3,120. Narration for this transaction is being goods sold for cash. Then goods purchased on credit. Here purchase account data, goods purchased from Raman Sons So to Robinson's account. The amount is 4,000. Purchase account data 4,000. To Robinson's account data, to Robinson's credited rupees 4,000. The narration for this transaction is being goods purchased on credit. Okay. Then next transaction is payment made to Marathi and Company in full settlement. So Marathi and Company account debited rupees 3,880. Bank account to bank account 3,800. The difference between these two is discount receipt. Discount receipt rupees 80. So that is the income for us. So that account will be credited. So narration for this transaction is big payment made to Marathi and Company in full settlement and discount receipt. Then next one is goods purchased on credit. Here journal entry first, purchase account data to Chatterjee account. So purchase account data 6,300 to Chatterjee account 6,300. The narration for this transaction is when goods purchased on credit. Okay. Then next one is goods returned to Chatterjee. Here Chatterjee account data to return outwards. Chatterjee account data to return outwards account. Chatterjee account rupees 300 to return outwards rupees 300. The narration for this transaction is being goods returned to Chatterjee. Then next transaction is goods withdrawn for personal use. So drawings account data to purchase account. Drawings account data to purchase account rupees 50. Drawings account data rupees 50, purchase account credited rupees 50. Then goods sold on credit to MN Company. So MN Company account data to sales account. MN Company account debited rupees 5,000 to sales account credited rupees 5,000. Then next one is check received from Channel Sons. So bank account data to Channel Sons account. So bank account debited rupees 1,440 to Channel Sons account rupees 1,440. Then the check of Channel Sons dishonor. Here Channel Sons is a receiver. So debit the receiver, Channel Sons account data, credit the giver. So bank is a giver. So bank account will be credited. So Channel Sons account data 1,440 to bank account 1,440. Then last transaction is cash deposited into bank. So bank is a receiver, so bank account will be debited. Cash goes out of the business, so cash account will be credited. So journal entry for this transaction is bank account data 2,000 to cash account rupees 2,000. The narration for this transaction is cash deposited into bank. Okay. Then date 27. Payment made to Chatterjee and discount receipt. So Chatterjee account data rupees 6,000 to bank account 5,850 to discount receipt 150. The narration for this transaction is being payment made to Chatterjee and discount receipt. Next transaction is salaries paid. Salaries account data to cash account. Salaries account data rupees 600. Cash account credited rupees 600. Then next one is rent paid. Rent account data to cash account. Rent account rupees 300. Cash account rupees 300. Then cash withdrawn from bank for our personal use. So drawings account data to bank account. Drawings account data to bank account. Drawings account debited rupees 500 to bank account credited rupees 500. The narration for this transaction is cash withdrawn from bank for personal use. Narration for this transaction, be cash withdrawn from bank for personal use. Okay, next after posting the transaction in the journal, then the transactions are posted to the ledger. First account, ledger of Ramesh. First account, we have to prepare the capital account. What is the opening balance of capital? 50,000. So opening balance of capital 50,000. Capital account always shows credit balances. So January 1st, buy balance brought down. Buy balance brought down rupees 50,000. Then the amount transferred to 31st January 50,000. Again that amount transferred to the next month. Next month of February 50,000. Is it clear? So the amount transferred to the next month 50,000. Then stock of goods account. Stock is the asset, so that shows the debit balances. So debit side, to balance brought down rupees 26,400. Then stock account. This is also opening balance, debit balance asset, debit balances. So to balance brought down 26,400. It is carried forward to the at the end of the month, January 31st, 26,400. Then this amount carried forward to the next month of February, 26,400. Okay. Next we have to prepare the cash account. Cash account is also a asset account. So that shows the debit balances. January 1st, to balance brought down rupees 630. January 1st, to balance brought down rupees 630. Then January 4, goods sold for cash. So to sales account 3,120. Goods sold for cash rupees 3,120. Then again January 4, carriage outwards expenses. So that account will be credited. Then January 24, deposited into bank. So by bank account 2,000. Salary is paid rupees 600. January 31st, rent paid rupees 300. So the total of the debit side is 3,750. The total of the debit side balance 3,750. So what is the balance difference between debit and credit side? 815 is the difference. So that is the balance in hand. So 815 rupees is a cash in hand by balance carried out in the month of January 31st. So 815, this amount carried forward to the next month, February 1, 815. Okay, so in the month of February 1st, cash in hand rupees 850. Cash in hand rupees 850. Then next account we have to prepare bank account. Here bank account, what is the opening balance? To balance brought down 23,100. 23,100. January 2nd, MN company 6,650. Okay. We received the cash from MN company 6,650. So to MN company 6,650. Then amount paid to Marathi and company in the month of January 5, 3,800. Then amount paid to Chandan Sons in the month of 22nd, 1,440. Okay, 1,140 is the check design. Then Chatterjee account 24th. Amount deposited into bank in the month of January 4. Bank account data to cash account rupees 2,000. Then Chatterjee, the amount paid to Chatterjee account 5,850 in the month of January 27. Then amount withdraw for personal use. January 31st, amount withdraw for personal use by drawings account 500. So the total of the debit side is 33,190. 33,190. So what is the difference between these two? 21,600. So 21,600 by balance carried on in the month of January 31st. So this amount was carried forward to the next month of February, 21,600. Okay. 21,600. That means at the end of the period, at the end of the month, we have bank balance rupees 21,600. At the beginning in the month of February, 21,600 is a bank balance. Then next account we have to prepare MN company account. So MN company is a debtors. So that is, it shows the debit balance. January 1st, to balance brought down 6,750. The amount check paid, check by bank account 6,650. 100 is a discount allowed. Then again credit sales 5,000. So the total amount is 11,750. The difference between these two 5,000. Okay. So 5,000 is a credit sales. That amount was settled by MN company account. So the month of February 5,000 is the 31st January. January rupees 5,000. So this amount transferred to the month of January 5,000. Okay. The next account, next we have to prepare the Marathi and company account. He is a creditors, so credit balance January 1st by balance brought down rupees 3,880. The account settled 3,800. The amount paid to Marathi and company 3,800. We had discount received 80, so the account would be closed. So 3,880. Here there is no balancing figure. The accounts are settled at Marathi and company. Then next account is Raman Sons account. Raman Sons account by balance brought down rupees 3,000. Again we purchased the on the credit rupees 4,000 in the month of January 5th. So the total amount payable is 7,000. So the liability, the creditors of Raman Sons, the amount payable to Raman Sons rupees 7,000. In the month of January 31st, again February 1st, the amount carry forward by balance brought down rupees 7,000. Okay. Then next to Chandran Sons. Here January 4th, 2 sales 1,440. January 28th by bank account 1,440. Then to bank account in the month of January 22nd 2,440. So the difference between these two, it is 1,440 in the month of January 31st. Then this amount carried forward to the next month, February 1st, 1,440. Then next to Chatterjee account. January 6th by purchase account 6,300. To return outwards rupees 300. To bank account 5,850. To discount receipt 150. So the total 6,300. So the strategy account will be settled. So there is no balances here. Then next account we have to prepare the purchase account. January 5th, Raman sends rupees 4,000 to strategy account 6,300. January 16th, buy drawings account 50. So the difference between these two, 10,000 to 50. So the total is 10,300. The next account is sales account. January 4th, by Chairman Sons, rupees 1,440. 4th, by cash account, 3,120. 17th, by MN company, 5,000. So the total is 9,560. So the difference between these two, 9,560 is the balancing figure. So to balance carried on 9,560. This amount carried forward to the next month. 9,560 in month of February 1. The next one is discount allowed. Discount allowed to MN company rupees 100. Okay, buy balance carried on rupees 100. That amount transferred to February 1st 100. The next one is carriage outwards account. To cash account 35. Buy balance carried on rupees 35. So the next one is discount receipt account. Discount receipt January 5th. We received the discount from Marathi and Company rupees 80. Discount receipt from Chatterjee rupees 150. So the total amount of discount receipt 230. So 230 transfer to the at the end of the month. Then this amount transfer the month of February 1st 230. Then return outwards account. Return outwards account by Chatterjee account rupees 300. Then balancing figure rupees 300. Then this amount transfer to the next month of February rupees 300. Then drawings account to purchase account, that is goods withdraw for his personal use 50. Cash withdraw from the bank rupees 500 for his personal use. So the total amount utilized for personal use 550. The balancing figure is 550. So the amount transferred to the next month of February rupees 550. Okay. The next account is salaries account. Salaries account to cash in the January 3rd to cash account rupees 600. 31st January buy balance carried on rupees 600. Then this amount transferred to the next month February 1 rupees 600. The next account is rent account. Rent account here January 31st to cash account 300. Buy balance carried on rupees 300. Buy balance carried on rupees 300. Okay, the next problem. Let us see. We are going to see the next problem. The following appeared in the books of Rahul on 1st January 2002. Asset, cash 40,000, stock 25,000, debtors 40,000, machinery 50,000. Then liabilities was given here, creditors Williams rupees 30,000. This is the opening entry. Then next one is following transactions took place in January 2017. January 3rd, sold goods for cash rupees 6,000 and on credit of rupees 3,000 to Ashley. January 5th, Ashley returned goods for rupees 1,500. January 9, purchased goods from Williams of the list price rupees 10,000 valued at 9,000. January 13, purchased goods of list price of 15,000 from Razor less 10% trade discount and 5% cash discount and paid 40% price immediately. 19 paid to Williams 38,600 in full settlement of his account. 23rd paid rupees 700 for the life insurance premium of the proprietor. Then January 30th receipt for commission rupees 2,500. Pass journal entries in ledger journal and post them into the ledger. So here in this problem they are prepared to journal and journal entries and how these transactions are posted to the ledger. So first transaction. First one is Rahul started a business. So they are the opening balances is assets. Here assets, the value of assets is cash 40,000, stock 25,000, debtors 40,000, machinery 50,000. So assets, all assets shows debit balances. So what is the journal entry for this? Cash account data 40,000, stock account data 25,000, debtors account data 40,000 and machinery account data 50,000. So all the assets are recorded as debit balances. Then liabilities. Creditors. Creditors is the liability. So Williams rupees 30,000. So that is recorded as credit balances. So to creditors account 30,000. So the difference between these two, that is considered as the amount of capital. So assets minus liabilities is equal to capital. So that should be considered here. Then next one is following transaction took place in January 2017. Here January 3rd sold goods for cash. So what are the accounts involved here? One is cash account and another one is sales account. Cash account and another one is sales account. So here January took place in January 2017. The above transaction was given in the month of 1st January 2002. So that is called opening entry. Here the transactions are done during the period of January 2017. So here sold goods for cash 6,000. Then and on credit of 3,000 to Ashley. So here there are two transactions. One is cash transaction and another one is credit transaction. Cash transaction is 6,000 and credit transaction is rupees 3,000 to Ashley. Here what are the account are involved here? One is cash, sales and another one is credit, name of the person, Ashley. Three accounts involved here. So cash account, Ashley account and sales account. Cash comes into the business, so that account will be debited. Okay, cash increases, so that account will be debited. Here Ashley is one of the creditors, so increase the liability, so that is also debited rupees 3,000. Then sales account, goods goes out of the business, so that account will be credited. Then next one is Ashley returned goods for rupees 1,500. So Ashley returned goods, that is a sales return. Okay, here who is the receiver here? So Ashley returned goods for rupees 1,500. So we have the receiver. So sales return account data to Ashley account. Then next one is purchase goods from Williams of the list price rupees 10,000, valued at 9,000. So purchased goods purchased from William. The list price is, the manufacturer's suggested price is called list price. So valued at rupees 9,000. So the list price is not recorded in the books of account. So here in journal entry is purchase account data to William account. Then purchase goods of list price of rupees 15,000 from Razor, less 10% trade discount and 5% cash discount and paid 40% immediately. So here there are both the discount are given here. 10% trade discount was given and 85% cash discount was given. That is, trade discount is given at the time of purchases, credit purchases, but in the case of 5% discount, that is allowed at the time of cash. So 5% discount allowed at the time of cash purchases. Out of this paid of 40% price paid immediately. So 40% of the price immediately given here. So the cash discount is allowed only for the 40% of the goods purchased. Trade discount is allowed for whole thing, that is 15,000 into 10%, 1,500. So the remaining amount here, out of that amount we have to calculate the 40%. So 40% of the price was given immediately. So we have to allow the discount. They allow the discount at the rate of 5%. The remaining 60% is considered as a credit transaction. So 40% of the goods which was paid for cash transaction and remaining 60% is considered as credit transaction. Then January 19, paid to Williams 38,600 in full settlement of his account. Here paid to William, you have paid the cash to Williams. So what are the accounts involved here? One is William account and another one is cash account. So William account and another one cash account. Here William is the receiver, so debit the receiver, William account will be debited, then cash goes out of the business, so that account will be credited. Then January 23rd paid 700 for the life insurance premium of the proprietor. So life insurance premium was given of the proprietor, so life insurance premium account data to cash account. Then January 30th receipt for commission rupees 2,500, receipt for commission. So commission is one of the expense income for us, so that should be credited. So journal entry is cash account data to commission account. So receipt for commission is one of the income, so that should be credited. So these are the transaction. First we have to identify the transaction, then what are the accounts involved for this transaction, then you have to apply the procedure, apply the rules for recording the transaction. So there is a procedure for recording the transaction in the books of journal entries. Okay, then next one is how these transactions are recorded in the books of Rahul. First you have to record the journal entries. So 1st January 2017, so opening balances of assets and liabilities. So what are the opening balance of assets and liabilities? That is assets and liabilities are given. Here what are the assets are given here? Cash account and another is stock account, debtors account and machinery account. Here liabilities like the Williams, creditors. So creditors was given rupees 30,000. So now you recorded as cash account debtor. Cash account debtor rupees 40,000. Cash account debtor rupees 40,000. Then stock account debtor rupees 25,000. Debtors account debtor rupees 40,000. Machinery account debtor rupees 50,000. Then liabilities to William. William account credited rupees 30,000. William account credited rupees 30,000. So the difference between these two is recorded as the amount of capital. So the total of debit side total is, what is the debit side total here? 5 plus 4, 9, 9 plus 4, 13, 13 plus 2, 15. Okay, 50,000 here. Credit side total is 30,000. So totally 1,55,000. So debit side totally 1,55,000. So credit side total 30,000. So 1,55,000 minus 30,000, 1,25,000. So that is the amount of capital. So you have to find out the amount of capital, assets minus liability. Here total debit side total is 1,55,000. 1,55,000. So 1,55,000 capital is equal to assets minus liabilities. So you have to add the all assets. Total assets is 1,55,000. Total asset is 1,55,000 minus 1,55,000 minus creditors. Creditors value is 30,000. Creditors value creditors value 30,000. So 1,55,000 minus 30,000, 1,25,000. 1,25,000 is considered as amount of capital. So what is the journal entry? Cash account data 40,000, stock account data 25,000, debtors account data 40,000, machinery account data 50,000, to Williams account 30,000. So the difference between these two is considered as amount of capital. So to capital account 1,25,000. The total of the debit balances is 1,55,000 minus credit side total is 30,000. So the difference is 1,25,000. So narration for this entry is Being opening balance of assets and liabilities are recorded. The next transaction is goods sold. That is 40% of the goods sold for cash and remaining 60% of the goods sold for credit transaction. So 10,000 actually list price, 10% is a trade discount. So 10,000 into 10%, 1,000. So 10,000 minus 1,000, 9,000. 9,000 is the value of goods. So out of 9,000, 60% is a cash and remaining percentage is a credit transaction. So 6,000 is a cash transaction. So cash account debtor. Then Ashley is a credit transaction 3,000. So cash account debtor, Ashley account debtor to sales account. So cash account debtor, here cash account debtor 6,000, Ashley account debtor 3,000, to sales account 9,000. That is, outer is a 9,000 here, 10,000 is the value of asset. So 10,000 is the value of goods. So out of 10,000, they allowed the trade discount. They allowed the trade discount of 10%. So 10% in the sense 10% of 10,000 is 1,000 rupees. Okay. So 10% of 10,000, 1,000 rupees. So the remaining amount is 9,000. Remain 10,000 minus 1,000, 9,000. So out of 9,000, 40% is a cash transaction, remaining 60% is a credit transaction. Then what is the journal entry for here? Cash account debtor, Ashley account debtor to sales account. So cash account debited rupees 6,000, Ashley account debited rupees 3,000, to sales account rupees 9,000. So the narration for this transaction is being goods sold. Then next one is sales return. Goods return from Ashley. Sales return account debtor to Ashley account. So sales return account debtor to Ashley account rupees 1,500. Then next goods purchase from Williams. Purchase account debtor to Williams account. Purchase account debtor to Williams account. So the narration for this transaction is being goods purchased. Then next one is goods purchased and discount received. Here purchase account, here there are 4 transactions: purchase account, cash account, discount account and razor account. Here purchase account debtor 13,500, to cash account 5,130, discount account 220, 270, to razor account 8,100. So the narration for this transaction is being goods purchased and discount received. So here cash account, so cash account 5,130, discount account 270, razor account 8,100. So the total purchases from razor rupees 13,500. They allowed the discount. Okay. The next one is goods purchased from Williams. Say they also allowed the discount. The total value of goods purchased from Williams rupees 39,000. Cash account rupees 38,000. Cash transaction, cash paid rupees 38,600. So remaining amount is considered as discount. So 1,400. So discount allowed 1,400. Then next one is drawings. That is the life insurance premium paid. So that is treated as personal use. So that amount utilized for the personal use. So we have to write the drawings account. So the insurance premium is paid for the official purpose, in the sense we have to record the insurance premium account, but this amount is paid for their life. So that is one of the personal purpose. So the premium amount is paid for his purpose. So this is recorded as drawings account. So drawings account debtor to cash account rupees 700. So drawings account debtor to cash account 700. Then cash, next one is commission receipt. commission receipt, that is income for us. So that should be credited, commission account credited. So cash account data to commission account. Cash account data to commission account. Now after recording the transaction in the journal entry, then how these transactions are posted to the ledger account. So ledger, first one is we have to prepare the cash account. Here this side called debit balances, here credit side total. First one is to opening balance, cash opening balance 1st January 2002, to balance brought down rupees 40,000. So opening balance of cash rupees 40,000. Then sales, goods sold for cash rupees 6,000, January 3rd 6,000. Then 13th cash purchases 5,130. Then Williams, that is January 19th, goods purchase from goods sold to William 38,600. Then drawings, life insurance premium paid, so that should be treated as personal use, so we have to write the drawings. Then commission receipt, that is income for us, so cash account data to commission account rupees 2,500. So the total of debit side total is 48,500. So you write it that same amount is the credit side 48,500. So the difference between these two is 4,070. So 4,070 is the closing balance of cash. So the end of the month, January 31st, buy balance carried down rupees 4,070. So that amount transferred brought forward to the next month. So next month, February 1st, 4,070. So cash balances shows debit balances. So if cash account shows debit balances, that is treated as asset. So that is a favorable balance. Then we have to prepare the next account is stock account. Here stock account, to balance, that is also debit balances. January 1st, they bring the stock to balance brought down rupees 25,000. So 25,000. Here there is no any other stock account here. So that account was closed. Buy balance carried down rupees 25,000. So the amount of 25,000 is carried forward to the next month, February 1st, 25,000 to balance brought down. So February 1st, to balance brought down rupees 25,000. Next account is debtors balances. Debtors account, you have to open the debtors account. So to balance 1st January 2002, to balance brought down rupees 40,000. Then 31st January 2002, 40,000. So this amount was transferred to, brought forward to the next month. So 40,000 in the month of February 1st. So at the end of the month, the debtors value is 40,000. That amount was receivable. So that amount was carried forward to the next month of February, to balance brought down rupees 40,000. So that is the opening balance for the month of February, 40,000. Next one is machinery account. Next we have to prepare the machinery account. So machinery account opening balance is 50,000. So 1st January 2002, to balance brought down 50,000. Here there is no machinery was purchased here but during the year. So that amount was closed here for 50,000, January 31st. Buy balance carried down 50,000. So this amount carried forward to the next month of February. So next month of February, rupees 50,000. So at the end of the month, we have the value of the machinery is 50,000. Then February, at the beginning of the month, February, opening balance of the machinery is 50,000. Then next one is Williams account. Williams account. Here the opening balance of creditors, opening balance of Williams Buy balance brought down rupees 30,000. So the opening balance is 30,000. He is the creditors. So it shows the credit balance. So buy balance brought down 30,000. Then January 9th, again we have purchased goods from William, rupees 9,000. Then the cash paid to William, rupees 38,600. Then discount allowed is 400 rupees. So the total of both the side total is tallied 39,000. Here there is no balancing figure. So the account settled the Williams account. So account, the full settlement of the account. Here there is no balances was arranged here. Then next account is capital account. Here capital account shows a credit balance. So first January opening balance of capital account is buy balance brought down rupees 1,25,000. So that amount was closed here. To balance carried down rupees 1,25,000. So this amount was transferred to the beginning of the month, February 1st, buy balance brought down rupees 1,25,000. Then next account, Ashley account. Here Ashley account. Here January 3rd, goods sold to Ashley rupees 3,000. Then goods returned by Ashley rupees 1,500 in the month of January 5th. So here there is no transaction in this Ashley. So you have to total 3,000. So 3,000 minus 1,500. 1,500 is the balancing figure. So the amount payable by Ashley is 1,500. That is a closing balance. Buy balance carried on in the month of January 31st. Then this amount was carried forward to the next month, February 1st, rupees 1,500. Then next account we have to prepare the sales account. So sales, January 3rd, cash sales rupees 6,000. Then goods sold to Ashley rupees 3,000. There is already sales transactions, that is Ashley to sales. So that account was recorded here. So the same amount, the Ashley account. Okay. So here Ashley account data to sales. Here sales account by Ashley rupees 3,000. Is it clear? Okay. Then what is the total of this transaction? 6,000 plus 3,000, 9,000. So the two balance carried on. 9,000. So this amount brought forward to the next month of February 1, 9,000. So February 1, 9,000 is the opening balance of sales in the month of February 1. Then sales return. Next account is prepare the sales return account. Sales return, that is Ashley returned the goods to us. So January 5th, 2002, Ashley returned the goods is 1,500. Here there is no return here. So buy balance carried down at the end of the month, January 31st, 1,500. So the accounts was closed here. This amount brought forward to the next month of February, 1,500. Then next account is purchase account. Here goods purchased from Williams. January 9th to Williams account 9,000. Then January 3rd, 13th cash purchases 5,130. Then discount allowed 270. Then razor account 8,100. So the total of 22,500. So buy balance carried down rupees 22,500. So this amount was brought forward to the next month, February 1st. Now we shall discuss the problems in journal. Journal is the transactions and post them into ledger. April 1st, 2017, Kamal started business with cash rupees 1 lakh. April 2nd, bought goods for cash rupees 30,500. April 3rd, opened bank account with cash rupees 50,000. April 4th, sold goods for cash rupees 40,000. April 7, bought goods from Surya on credit rupees 30,000. April 10, sold goods to Rakesh on credit rupees 25,000. April 15, purchased plant and machinery rupees 50,000. Settled the dues as follows. Giving in exchange an old machine owned by Kamal valued at rupees 10,000. Issued check from his savings account rupees 25,000. Balance paid by check. April 19, paid to Surya in cash. April 21, received loan from Anil and deposited the same into bank rupees 8,000. 23rd, goods returned to Surya rupees 1,000. 26 April, withdraw from bank for personal use 5,000. 27th, paid to Surya by check rupees 8,000. 29th, received cash from Rakesh rupees 10,000. 30th, purchased stationery for cash rupees 200. Last 30th April, paid wages and salaries rupees 10,000. Okay, these are the different transactions. These transactions are made in the month of April 1 to 30th. Here first transaction is Kamal started business with cash. Okay, Kamal started business with cash. Cash account and another one is capital account. Cash account and another one is capital account. Cash account and another one is capital account. Here cash is also increase, capital amount is also increase. So here cash account debited, capital account credited. Cash increase, increasing asset. Capital is also increasing asset. So cash account debited, capital account credited. Both is for cash. Purchase account and another one is cash. Bought goods for cash. Here there are two accounts involved here. One is purchase account and another one is cash account. So purchase account debited, cash account credited. Open bank account with cash. So here there are two accounts. One is cash account and another one is bank account. Cash account and another one is bank account. So bank account debited, cash account credited. Sold goods for cash. Here cash account and another one is sales account. Cash account and another one is sales account. Cash account debited, sales account credited. Bought goods from Surya on credit. Bought goods from Surya on credit. Purchase account and another one is Surya account. Sold goods to Rakesh on credit. Rakesh account. Rakesh account and sales account. April 15, purchased plant and machinery. Plant and machinery account data. Plant and machinery account debited. Savings, we should check from his savings account. Balance amount paid by check. Then paid to Surya in cash. So cash account and another one is Surya account. Received loan from Anil, deposited into same into bank. Received loan from Anil. So cash account and another one is Anil account. And immediately deposited into bank. So the amount was immediately deposited to bank. So bank account returned to cash. Goods returned to Surya. Withdraw from bank for office use, personal use, to drawings account, to bank account, drawings account and bank. Pay to Surya by check. So Surya next one is Surya account and bank account. Is it cash from Rakesh? Cash and another one is Rakesh account. Purchase stationery for cash. Stationery account debited and cash account will be credited. Wages and salaries account debited and cash account will be credited. Okay, now we are going to see about solution of the problem. Okay, let us see solution of this problem. Business started with cash. So what are the accounts involved here? One is cash account and another one is capital account. Cash account and another one is capital account. So cash increases, increase in asset, or cash is relating to real account. Debit what comes in, so cash account will be debited. Increase in asset in the sense asset increases, the transaction will be debited. Then capital is also increase, so the capital account will be credited, rupees 1 lakh. So the journal entry for this transaction is cash account data to capital account rupees 1 lakh. The narration for this transaction is being the business started with capital of rupees 1 lakh and brought in cash. The next one is April 2. April 2nd, bought goods for cash. So purchase account data to cash account. Purchase account data to cash account. Okay, purchase account data rupees 30,500. Purchase account data. Purchase account data rupees 30,500 to cash account rupees 30,500. Narration for this transaction is being the goods purchased for cash. Then April 3rd, bank account data to cash account. Bank account data to cash account rupees 50,000. Bank account data to cash account rupees 50,000. Narration. The narration for this transaction is being the bank account opened by depositing cash into bank. Then is the goods sold for cash. Cash account data to sales account. Cash account data rupees 40,000 to sales account rupees 40,000. Okay. Then next one is being goods purchased on credit from Surya. Okay, purchase account data to Surya account. Purchase account data to Surya account. Purchase account debited rupees 30,000. Surya account rupees 30,000 credited. Then next one is goods sold to Rakesh on credit. Rakesh account data to sales account. Rakesh account debited rupees 25,000 to sales account credited rupees 25,000. The narration for this transaction is goods sold to Rakesh on credit. Then plant and machinery purchased. So plant and machinery account data, the savings amount should be utilized for payment of plant and machinery. So that amount transferred to the capital account. So 10,000 plus 25,000 which are taken from the savings account. So 35,000 which is transferred to the capital account. Then remaining amount paid by check. So remaining 15,000 credited with bank account. So plant and machinery he purchased 50,000 in exchange of the old machine valued at rupees 10,000. So 10,000, 25,000 is taken from the savings account. This amount transferred to the capital account. So plant and machinery account data to capital account 35,000, remaining amount paid by check 15,000. So to bank account 15,000. The narration for this transaction is being the plant and machinery purchased and payment made by giving an old machine valued at rupees 10,000, check from savings account rupees 25,000 and balance from firm bank account. The next one is amount paid to Surya in cash. So Surya account data to cash account. Surya account data to cash account. Surya account data rupees 10,000 to cash account 10,000. Then next one is loan from Anil. Loan from Anil received and deposited into bank. Received and deposited into bank. $8,000 bank account data to Anil's loan account. Bank account data 8,000 next to Anil's loan account rupees 8,000. Being the loan from Anil received and deposited into bank. Then next one is goods returned to Surya. Here Surya debit the receiver, so Surya account will be debited. Return outwards, that is purchase return, that should be credited. So Surya account debited rupees 1,000, return outwards rupees 1,000 rupees credited. Then amount withdraw from bank for personal use. So drawings account will be debited, bank account will be credited. So drawings account data rupees 5,000 to bank account rupees 5,000. Narration for this transaction is amount withdrawn from bank for personal use. Then April 27, amount paid to Surya by check. So Surya debit the receiver, so Surya account debited, bank paid by check, so bank account will be credited. So there are a journal entry for this transaction is Surya account debited, Surya account data rupees 8,000 to bank account rupees 8,000. The narration for this transaction is weighing the amount paid to Surya by check. Then cash received from Rakesh. April 29, cash received from Rakesh, cash account data to Rakesh account. Cash account data to Rakesh account. Cash account debited rupees 10,000 to Rakesh account credited rupees 10,000. The narration for this transaction is cash received from Rakesh. Then April 30th, stationery purchase for cash. So stationery account data to cash account. Stationery account data to cash account. Stationery account data rupees 200. Cash account credited rupees 200. April 30th, wages and salaries paid. So wages and salaries account data to cash account. Wages and salaries account data to cash account. Wages and salaries account data rupees 10,000 to cash account rupees 10,000. Okay. So these are the different transactions. These transactions are entered in the books of journal. Then next one is we have to prepare the ledger accounts. So what are the accounts are prepared? Here first one is cash account, capital account, purchase account, bank account, sales account, Surya account, Rakesh account, plant and machinery account, Anil's loan account, return inwards outwards account, drawings account, stationery account, and last one is wages and salaries account. So these are the group of accounts. These accounts, for example, cash account. Here all cash receipts and payments are recorded under the head cash account. So there is called group of accounts. Okay. First we have to prepare the cash account. So here this is debit side. Here credit column. So the format is date particulars for journal folio rupees. Date particulars, this column is credit column. So first one is cash account. 1st April 2017 to capital account rupees 1 lakh. Then 2nd April 2017 purchase goods for cash 30,500 by purchases 30,500. April 3rd amount deposited into bank, open the bank account. So bank account data to cash, so 50,000 by bank account. Then cash sales 4th April 2017 cash sales, so 2 sales rupees 40,000. Then next one is amount paid to Surya rupees 10,000 in the month of April 19th. So by Surya account rupees 10,000. Then April 29 paid to amount received from Rakesh, so to Rakesh rupees 10,000. Then stationery paid rupees 200 in the month of April 30th. So by stationery from 200. By wages and salaries in the month of 30th April rupees 10,000. So you have to add the debit side total 1,50,000. So the balance between these two is 49,300. So 49,300 is transferred to by balance carried down. So 30th April by balance carried down rupees 49,300. So this amount transferred to the next month. 1st May 2017 is 49,300. Okay. Okay, next account is capital account. Capital account, to balance brought down. Okay, to balance brought down. Okay, the amount invested is rupees 1 lakh, 1st April 2017. So by cash account rupees 1 lakh, 15th April 2017, plant and machinery purchased in exchange of old machine rupees 10,000 plus savings amount 25,000, so totally 35,000. The total amount of 1 lakh plus 35,000, 1 lakh 35,000. So 1 lakh 35,000. So to balance carried on. So to balance carried on rupees 1 lakh 35,000. Then this amount transferred to the next month, 1st May 2017, 1 lakh 35,000. The next account is purchase account. Purchase account, 2nd April 2017, cash purchases 30,500. Credit purchases to Surya account rupees 30,000. So the total purchases is 60,500. The total purchases rupees 60,500. This amount transferred to the at the end of the month, 30th April, 60,500. So the total is 60,500. The balance amount is 60,500. So 30th April 2017, by balance carried on 60,500. This amount transferred to the next month, 1st May 2017, to balance brought down is 60,500. Okay. Next account is bank account. Next account we have to prepare the bank account. 3rd April 2017, bank account data to cash account rupees 50,000. Then 15th April, by plant and machinery rupees 15,000. Then 21st April, to annuals loan account rupees 8,000. Then 26th April 2017, by drawings account rupees 5,000. 27th April, by Surya account rupees 8,000. So the total of the debit side is 58,000. So 58,000. So the balance would be these two is transferred to by balance carried on. So 30,000 is a by balance carried on the month of 30th April 2017. So 30,000 is transferred to the next month of 1st May 2017, rupees 30,000. The next account is sales account. Sales account for 4th April 2017, by cash account rupees 40,000. 10th April 2017, by Rakesh account rupees 25,000. So the total is 40,000 plus 25,000, 45,000. Sorry, 40,000 plus 25,000, 65,000. So 65,000. So the balance between these two is transferred to by balance, to balance carried on 65,000. 65,000. Again this amount transferred to the next month, 1st May 2017, by balance brought down. By balance brought down rupees 65,000. Okay, so 1st May 2017, the opening balance is 65,000. So this video. Surya account, 7th April 2017, by purchase account rupees 30,000, 19th April to cash account 10,000, to return in outwards rupees 1,000, to bank account rupees 8,000. So the total is 30,000. The balance between these two is 11,000. So two balance carried on the month of 30th April rupees 11,000. So this amount transferred to the 1st May 2017 rupees 11,000. The next account is Rakesh account. Rakesh account, 10th April 2017, two sales 25,000, cash, by cash 10,000. So the total is 25,000. Total is 25,000. So the balance between debit and credit side is 15,000 is the balancing figure. So 30th April 2017, by balance carried on 15,000. So this amount is transferred to the next month. Two balance brought on rupees 15,000. The next account is plant and machinery account. 15th April 2017, to capital account 35,000. 15th April 2017, to bank account 15,000. So the total is 50,000. So the total of both the side 50,000. The balancing figure is 50,000. So by balance carried on rupees 50,000. This amount transferred to the next month, 1st July 2017, 50,000. The next one is Anil's loan account. Anil loan account, 21st April 2017, by bank account rupees 8,000. So there are no transactions here. So 8,000 other accounts are closed. So 8,000. So balancing figure is 8,000. 30th April 2017, the balancing amount is 8,000. Then this amount transfer to the next month. 8,000. So 8,000 by balance brought on.
I hope you understood that the function of systematic analysis of the recorded data to accumulate the transactions of similar type at one place is performed by maintaining the ledger in which different accounts are open to which transactions are posted.